Hello, this is Jeffrey Cohen, Chicago Quantum. How are you? It's week 6 of the markets, 2022. We're going to talk today in a very focused manner on the Chicago Quantum Net Score down run, the stocks that were supposed to go down or move sideways last week. We ran this model on February 1st, and we're going to share with you the top 50 down stocks and highlight a few of them, and maybe what your takeaways can be from the stock run. We'll stay very focused on the model and its outputs. So the number one stock picked by Chicago Quantum for down is LWLG, or Lightwave Logic. So this stock is expected to return 19% based on its beta and the market return over the past year. It traded 224% volume versus the average of every day's volume last year. It's up 39% versus last year. The variance is a 7, which is actually very high in our model. So most stocks will be around a 1, and there's no dividend. So if you want to short it, there's no cost. Tempest Therapeutics, number 2, 21% expected return. Only 1% volume versus the year before. So the volume is down 100 times. You're only trading 1% of volume the day before. And that's interesting. So the stock is trading at 52% of last year's average price. So it's down 48% versus last year with a pretty high variance of a 5. Those are normalized variances. And if you go through the list, AADI, PETZ, TCAT, PHUN, SCKT, and you'll see most of these stocks have in common either their variance is very, very high, 7, 5, and 12, so they're going to fly like crazy, or their variance is very low. But in this case, very low variance, very high volume, if you look at PETZ. This one, CRTX, it's one of the worst performing stocks in the market. It's down 85% over last year, but a tremendously high variance, 17, and it traded 322% of last year's volume. Another high volatility stock, high variance stock, is ANVS Bio, ANVS, expected to return 18%. The volume versus last year's 11%, and it's down 60% over the past year. You know, as we went through these stocks, one of them stood out for us last week, and it was HLBZ. This stock is expected to return 3%. Tiny beta. So right away, what that should trigger to you is that the stock is moving independent of the overall market. Something's happening driving that stock. The volume is down 16% of last year's volume. The price is down only 32% of last year, so it's down 68%, and it's a very low volume, very low variance stock. So I wondered to myself, why are the pumpers and the memers talking about HLBZ? So I went out there and I took a look at the stock. Let's see if I can find it. I know I have it here somewhere. Here we go. So if we look at HLBZ over the past week, let's go for the past month. Where were we? So the stock was down, and then all of a sudden, it popped lower, and then it popped up. It actually moved about 30-ish percent, 33%. And so what's interesting is, here's a stock that's down with low variance, low movement, but the model picked it. So we took a look at social media, and we see, boom, stock popped up. Now, it doesn't mean the stock will stay up, but it just means there's a lot of movement on the stock without real conviction. Another stock where we saw this, and this was over the past, let's say, month or two, is STRN Company. So STRN Company was picked as a stock that, it was a couple months back. I'm actually going to go back. So it was picked post-IPO right when it was around $3, late November. When the stock got driven up to $6. And you can see it tried to make it, $6.27. Tried to go $6.50, $6.37. For those who know their stock patterns, kind of feels a little bit like a Head and Shoulders if we saw the volumes in there. And then all of a sudden it didn't make it. It came down. It did a little head fake, whereas it tried to reach the previous neck. It did not. Now it's down under $2. And so I wouldn't be surprised if HLBZ has the same pattern, right? A lot of motion, not a lot of action. So Phunware is another one. So Phunware, number 6 in our model. And so if we take a look over the past month, and Phunware has been showing up a little while, you can see how the stock has moved up and down over the past week. And then today on 48 million shares, leapt up. And then 16.2 million shares. This thing is traded 65 million shares. So Phunware, if you would have followed our model, if you would have seen it last week, you would have known this thing is exploding with volatility. So if you look at where it was last week, Monday, it was trading 113% volume versus the last year. So volume's about the same. Price is up 20%, not really moving much. Expected return of 21%. And the variance was pretty low. So you look at the stock and you think, there's no reason for this to trade 64 million shares when on average it trades 17. And that's as of 10:30 in the morning. So you might have looked at the model and said, you know what, I'm going to short it, or I'm going to straddle it. So I'm going to go long and short because I know this thing's going to move, right? So our Chicago Quantum net score down run shows stocks that are just going to drop and others that are just going to have wild volatility without much movement. Now, if you like a rodeo and if you like to play the option market and find stocks that are really going to move, really going to get your adrenaline up, this is basically the list for you. Let's look at LWLG. So here's a stock that our model said was a stock to avoid or a stock to drop. And it's been saying that, I'm not going to say it's been saying that since December 10, but it's been saying that for a while now. So let's say you would have found that stock at around 15, 20 bucks in our model. It's now 7. And so what's happened is it's fallen completely down. But even here, you see a little bit of wild volatility, dollar swings in a day. And so, again, if you love volatility, that's great. If you're a rodeo rider and you want to swing this thing, there's movement almost every day in it. But in general, if you want to sleep at night, this is a stock that you would avoid because it drove up really for no reason. It's not profitable. And it came down for no reason. It's not profitable. It wasn't up for any good reason. And so if we look at the last 3 years of earnings per share down 7 cents, negative 8 cents, negative 8 cents. Revenue 0. They don't make any money. So they don't even earn anything. Chicago Quantum earns more than Lightwave Logic. So just think about it. Here's a stock that our model picked number 1 in the list for over a month. And you would have seen it. Now, Tempest is another one. So Tempest is right in the middle of the game here. So our model picked it over the past couple of days. I would say the past week, week and a half. So we look back. Where was it a week, week and a half? Right around here. So let's go back 6 months. So it was a steady downturn. Then all of a sudden you see some volume spikes and it starts to move, right? So you look at it for a month. You look at it for 5 days and you see that kind of volatility, that crazy movement for Tempest. Tempest is a sleepy stock. It's a $25 million market cap. It really shouldn't be going anywhere. It's traded 1,600 shares today, right? Yet it shows up in our model as having an inordinately high volatility. So if you want to swing something with a low volatility, hey, maybe it's a chance to shoot the moon. Maybe it's a chance to go to 0, right? It's up to you. But these are stocks that are going to move without commitment, without direction, just volatility. And the volatility is much higher than the expected return. So it is volatility for the sake of volatility. Just to take a look at the colors for a minute. And let's see if we see any patterns in the top 50. So the first thing we see is that the last day's volume when we ran it was in general very low. So these stocks had stopped trading. They were 20%, 3%. We see that 2%, 1% of last year's average volume. The stocks are down. Only 2 stocks are green, meaning they're up 50% more than they were last year. In a market that went up crazy, you would think there'd be more. Most of these stocks are down over the past year. So when we give you a down run, In this case, it's picking stocks that are vastly lower. And then you get this nice, you get a taste here of, you could pick some really high volatility stocks, right? 9 times a normalized run, 17, 18, 14. Ergo, EAR, 14. GameStop, GME. I mean, you already know GameStop's a bit crazy. CCXI at 10. FREQ at 14. ANVS. CRTX. These are stocks that you can, first off, you avoid if you're a conservative investor. If you've got, due diligence in mind. But again, if you're looking for a rough ride, stocks that go up and down crazy, stocks that will most likely crash on you, most likely fall from $20 to $7. And you want to look at that list. Now, what was interesting about these stocks as we followed them, I'm going to go back to a chart of the S&P 500 for you, because I want to show you how you really made money with this set. So let's say you ran the model. February 1st. All right, here we are. So we ran the model and we picked it here. February 1st, end of day. Okay? So you were at an S&P 500 of 45.45. And so the next day you would have started shorting stocks. You would have bet against. Maybe you would have bought puts. And you would have done it throughout the day. And the good news is, while you're shorting, it's going up. So a lot of these stocks probably had a last hurrah. Your puts were probably dirt cheap. And you were doing okay. And then the market fell out from under you. So you just had this feeling, you know what? It's a bad day. I'm going to buy the down run. And I'm going to go short, basically. Well, this collapse of the market, this gap lower from 45.88 to 45.17, these stocks collapsed. In many cases, these stocks were down 10 to 30% in one day. And then you would have bought them back, and you would have paid for your $750 model run in about 3 minutes, right? It's no big deal. And then they kept falling, right? One day they were down. The next day they were down. Now they're coming up. They're coming down. So what we're finding is the stocks are not all up and down. It's not like you're going to buy the run and it's all going to go to zero. But you're going to get stocks that are going to move lower when the market falls. Think of it as like an S&P 500 put. Except it's going to pay a lot more. It's going to be a heavily leveraged put because these stocks are truly going to drop faster than the S&P 500 according to our model. It's an interesting run. So I'm going to leave you with this thought. Oh, one other thing I wanted to cover. I'm so sorry. I want to cover something else we found in the model that we thought was interesting for you. So there were stocks that we picked here that were leptokurtic with a positive skew and a low variance. So Jeff, what the heck does that mean? Platykurtic means flat tail. You don't know where the thing's going to go. If the average return, let's say, is 0, this thing could be +1, -1. +3 standard deviations, -3 standard deviations. I don't know. So, no, I said it wrong. I'm so sorry. That's platykurtic, flat tail. This is leptokurtic. So these are very narrow. So if the stock typically returns, let's say 0, goes up 0 for the year, then the typical returns over the past year are more narrow than a normal distribution. So these are tightly grouped daily returns over the year and with a low variance. So these should have been your safest stocks over the week. COHR, MIC, and NUAN. And you've probably heard of all of these. So let's dig in. I just need a minute to find them. I apologize. We are not going to talk about any stocks that we own. It's a commitment that I made to you because I don't want to have any issues. But I'm just looking for that tab. And wow, where is that tab? We already covered those. We already covered the S&P. We'll find them. Here we go. Knew I had it out here for you. Macquarie Infrastructure Holdings. Now, they sold off a division that they thought was profitable. And so you would look at the stock and you'd say, all right, it generally speaking moves only first thing in the morning, and then it's pretty flat, pretty tight range. So if you would have invested in this stock, you would look. Morning and evening, it kind of moves kind of crazy, but then during the day, it's pretty flat, no movement. So Macquarie paid a huge dividend last year. Now you got NUANs. Let's take a look at NUANs. Over the past week, NUANs moved down a little, moved up a little. Moved down a little, moved up a little. Moved down, moved up, moved down. Now, over the week, it's interesting. It's up 15 cents. So this is a stock that just isn't moving. So today it's up a penny. So let's say you wanted some dog stars, you wanted some of that negative exposure, but you didn't want a lot of movement. Money losers with too high a risk, but in this case, they're just money losers, but there's not a lot of risk. And so you might look at it and say, you know what, I want some of those. I like losers. Coherent. Let's take a look at this one. Now, when I say losers, I say money losing stocks, like they have negative net income, but maybe they're okay. They're just very low volatility, very low risk. So here's one that's interesting. It kind of broke the mold a little bit, right? So this one started the week at 255, and it ended the week at 256. Actually, it ended the week at 255. It exactly stayed the same. There was a tiny bit of movement up, flat, down, flat, back up. So these are stocks that if you want to put them in your portfolio and not have a lot of movement, there's a tiny bit here. Then that's interesting. So I bring this up because in one of our next discussions, we're going to talk a bit about this. What if I want to pick stocks that are supposed to go up that have this? So these are stocks that are supposed to go down or not such good stocks that have a very tight trading range, that are leptokurtic, positive skew, and low variance. So I just found you 3 stocks that don't move very much at all, but probably not going to go up much. And so we run that in our model, and we give these types of stocks to our clients. Now, let's say you wanted to trade options on these 3. I don't know if they have options, but these are ones where they're probably going to expire worthless. And if you're trying to earn premium, you can do that. So I want to thank you very much for listening. This is Jeffrey Cohen. You can follow us on Twitter. We are Chicago_Quantum. You can check out our website, which is just Chicago Quantum. We are registered investment advisors. We're consultants. We provide just a ton of information about the markets. We do research. We provide insights from our runs. And we sell services. We sell an up run. We sell a down run. That's our primary service. We also will help you develop your own custom algorithms, which we can run for you, or we can turn over the code and you can run it. You know, that's a weekly charge. And we also do investment planning workshops. If you want to take advantage of some of these tools, we're happy to let you do that. We also run project services. This is typically more like for companies or for researchers that want to bring in some quantum enabled or data analytics type people to do coding for them. And we got that. So hope you enjoyed the video. Take care now. Bye-bye.